All right, everybody, welcome to the Josh Sells MF YouTube channel. My name is Josh, and obviously I sell multifamily real estate. I'm licensed in North Carolina and soon to be South Carolina, and I represent the Blank commercial real estate firm in the Charlotte, North Carolina area, which is one of the top commercial real estate firms in the entire state. Today I just want to scratch the surface on a little bit of multifamily real estate, what that looks like, what to look like, and how to value a property, because it's a lot different than your residential 1 to 4 single family home, 1 to 4 unit single family homes, in terms of you can make a lot of money in multifamily real estate, you can lose a lot of money in multifamily real estate. And there's two things you need to know before you even go look at a property, before you even call your agent or your broker, before your broker even calls you in reality, is you need to know the cap rate, because that's going to determine if that property is going to meet your financial goals, short-term, long-term, whatever your investment strategy is, and if you're going to be able to come to terms on that property to make sure it's going to work for you. So I want to dig deep into what is a cap rate, how do you find a cap rate, and then how do you know what classification of property are you in? Are you in an A class, B class, C class, or D class property, and how that's going to affect your strategy and what your desired cap rate is. So let's dive in here with cap rate and what you need to know to get your cap rate. And really, all you need to know is two things. You need to know your NOI, which is your net operating income, and you need to know your value, or the asking price of the property to get your cap rate. And cap rate stands for your capitalization rate, and basically that means it's the factor in which you're going to get a return on your investment. How quickly are you going to make your money back on this property? So it's really simple. To get your NOI, what we do is we take our gross income for the property, and then we're going to minus all of our operating expenses. Not counting your debt service. Okay? So, let's figure out an example here. So let's say your gross income is $100,000 per year. Okay? Then your operating expenses are $5,000 a month. So let's say those are $60,000 a year. Okay? So 100,000 minus 60,000 is going to give you a NOI of $40,000. Okay? Now, let's say that this property is for sale, not really valued at, but for sale for, let's call it $850,000. Okay, so we know our two numbers. We know our NOI, we know our value. What's the cap rate? You take your NOI divided by your value equals, get our trusty iPhone calculator here. We're going to do 40,000 divided by 850,000 equals 0.047. Okay? Math tells me I'm going to move my decimal point twice, equals a 4.7 cap. Basically 4.7%. Okay? Now that's not very good based on your goals. And I'll get into a little bit of what is a good cap rate based on what the property is and where it's located. And that's going to be the biggest factor when determining if that cap rate works for you. The bigger the cap rate, the bigger the return. The lower the cap rate, the lower the return. Let's flip this around a little bit though. Let's say that we have this same exact scenario here, but my client says, you know, Josh, I'm not interested in looking at properties unless I have a 6% cap or better. Okay? But I know that the NOI is $40,000 in this property, and the person is asking $850,000. So, you know, before I even bring this, you know, to my client, I want to say, okay, this matches everything that my client wants, but that cap rate is just way too low. There's no way I can get there. And quite frankly, they're never going to sell it at that cap rate because of the location that it's in. So what is our value if we want a 6% cap? So same thing, trust the iPhone calculator, very simple, 40,000 divided by 0.06, our cap that we want, equals, that's funny, 666.66 right? So that's pretty funny, a lot of sixes there. What I would do is I would round that down to 650,000, and that is the conversation. That's where I would start with the conversation with the property owner to see if we can get there. Now let's say I can get it for $650,000, right? Let's say we get it for 650K. What would our cap rate be? 40,000 divided by 650,000. It would be a 6.15 cap, which is going to meet my investor's goals. Okay? Now, an excellent question that I get a lot is, why don't we use debt service when calculating the NOI? Because debt service can vary from investor to investor on how long they've been investing, how old they are, what their cash reserves are. Because if you put $50,000 down on a $5 million property, your payment is going to be way different than if you put $3 million down on a $5 million property. So the debt service is going to come into account when you want to get your gross cash flow, but not your NOI. So your gross cash flow is going to be your NOI minus your debt service. That's going to give you your gross cash flow per year, which is going to basically how much money are you going to put in your pocket or in your bank account. After all expenses are paid, all your expenditures, all your, in your operating expenses, we're taking into account your vacancy. We're taking into account your property management. We're taking into account your cash that you're setting aside, your cash reserves, right? We're taking into account your collection cost. Literally anything except for your debt service to get that NOI, because that's going to give you the most accurate number for that property in that area. Okay? So that sums up your NOI, your value, how to work backwards to really determine, what you're going to pay for that property and if it's going to be a deal or not. Because at the end of the day, the numbers are all that matters. So let's move on to what is a good NOI in what area. So we get rid of all this, or a good cap rate. I'm sorry, not a good NOI. We want the NOI to be as high as possible, don't we? All right. So in resident or multifamily real estate, you have classes of properties. Okay. You have your A's, your B's, your C's, and your D's. Okay. These are your war zones. Okay. So these are poor properties in poor locations. A little bit better than the war zones, but still pretty rough. We'll call those transitional areas, right? Your B's are pretty good, and your A's are going to be your top of the line locations in your top of the line property. So you're going to have classes of your properties A, B, C, D, and your locations A, B, C, and D. Now what this is going to do is going to affect your cap rate. In the A properties, you're going to have a lower cap rate. Your D properties and locations, you're going to have a higher cap rate. And I'll explain why. So D's, in the Charlotte market, you're about 7.5 plus on your cap rate. C's, you're going to be between a 6.5 and a 7.5. B's, you're going to be between a 5.5 and a 6.5. And A's, you're going to be between a 4.5 and a 5.5 cap rate, okay, for your areas. And what that means is with these, you're going to make your money back faster. Okay, you're going to make more money, but it's much greater risk because you're in a D location. C's, a little bit better, or a little bit less cap rate, so a little bit less income, a little bit less money, a little longer to get your return back, but it's a little bit better location. B's, a little bit less cap, a little bit safer, and then the A's are going to be your safest investment with your smallest amount of gain realized over a short period of time. These are going to be your I don't want a lot of risk but I still want to own multifamily. These are, I want as much risk as possible. It could be in the middle of the worst area and the most rundown piece of property. I want it because I know I'm going to make more. You may even see, 10% plus caps on these D properties and D locations. My strategy when I'm working with investors is I like to find the C properties in the B locations, okay? Or the B properties in the A locations, because you're gonna make the most money on your appreciation in these A, B locations. And if we can do a little bit of work to these properties, make them better, but they're still in a great area, we're going to make a really great return for the investors, and in turn, everybody's going to be happy. The customer, or our investor, our client is going to be extremely happy with their investment, and the property owner is going to get the property sold, and everyone's going to be happy. It's going to be a win-win-win. So I hope this was helpful. I hope this gives you a little bit of an in-depth understanding of what to look for when you're looking at multifamily properties, and how we can help you kind of meet your goals and meet your investors' goals and our investors and our clients' goals. So feel free to reach out if you have any questions, and stay tuned. Make sure you hit the subscribe button. I want to provide as much value as possible, totally free of charge on YouTube. Check it out, share with your friends, and hopefully this gave you a good understanding of what the market is like in Charlotte, and really how you can get into the multifamily real estate investing. Upcoming videos, I'll talk about different ways to finance, walkthroughs of properties that we have under contract, and more videos that hopefully can provide as much value as possible. So again, thank you guys for checking this out. Hopefully this was insightful. Share with a friend and click the subscribe button. Thanks again.